$100,000 sits in a digital bank account. It looks safe, it looks secure, and it feels absolutely comforting, but it's actually dying. But your brain is lying to you. The cash isn't sitting in a secure vault. It is slowly burning away in an invisible, silent fire. This is the money illusion, a critical psychological blind spot that makes us focus on nominal numbers while completely ignoring real purchasing power. If you receive a 2% raise in a year when inflation runs at 4%, your brain makes you feel richer. Yet your wallet is 2% worse off. The absolute nominal number went up, but your actual purchasing power plummeted in secret. This is exactly what financial institutions count on. They plaster massive nominal yields in their bank windows to trigger emotional security. In 1980, bank customers were absolutely delighted to lock in 11% on bank certificates of deposit. But after accounting for inflation, they were actually losing wealth. Their high interest rate was just a beautifully packaged smokescreen. Conversely, in 2003, a 2% CD yield felt disappointing, even though it actually protected capital from low inflation. Inflation does not take out billboards. It does not advertise. It silently, invisibly claws away the baseline value of your hard-earned dollar. Holding 100% cash over several decades is not conservative. It is a slow-motion mathematical suicide that destroys empires. In the United States, from 1973 through 1982, consumer prices more than doubled, compounding at 9% annually. A single dollar bill in 1973 was worth less than 45 cents just 10 years later. Cash was completely demolished. Since 1960, 69% of market-oriented countries have suffered devastating high inflation cycles, erasing more than half of investor wealth. Governments borrow trillions. They have zero economic incentive to kill inflation because it allows them to pay debts with cheaper, depreciated currency. So where do you run? The standard reflex is to dump cash and buy physical gold, but history proves that gold fails. From 1935 to 1972, gold rose just 35%, paying zero yield while charging investors active storage fees. In fact, leaving cash in a simple interest-bearing savings account over that period easily outperformed gold, despite rising consumer prices. Ordinary investors cannot safely protect their purchasing power by betting on highly volatile physical assets, diamonds, or master paintings. Direct real estate offers some protection, but it is highly illiquid, subject to massive location errors, and impossible for moderate means to diversify. To survive, the passive investor needs a completely different fortress. But first, they must totally redefine what investment risk actually means. Wall Street defines risk purely as volatility. If a stock price fluctuates wildly up and down, professional analysts instantly label it high risk. Benjamin completely rejected this definition. He argued that a temporary price decline in a high-quality stock is not a true risk. True risk is a permanent loss of capital, caused by actual business deterioration, or paying an excessively high price during bull markets. If you own a diversified basket of prominent, conservatively financed corporations, short-term market price swings are nothing but background noise. A defensive investor is not someone who is timid, weak, or afraid. They are simply passive, valuing ultimate simplicity over hyperactive trading. The active investor spends immense energy and hours researching, selecting, and constantly monitoring a dynamic mix of stocks and bonds. This enterprising approach is physically and intellectually taxing, requiring a highly competitive edge and an endless commitment of daily personal time. The defensive investor, however, runs on absolute autopilot. This strategy takes zero daily effort, but demands an almost ascetic emotional detachment. Financial risk does not reside in the market, in the economy, or in the charts. It lives deep within your own emotional behavior. master your internal behavior, Benjamin Graham engineered the ultimate weapon, a mechanical asset allocation formula that runs entirely on autopilot. The rules are deceptively simple. You divide your entire investment portfolio between high-grade common stocks and high-grade bonds. The core guideline is that you must never have less than 25% of your total assets in common stocks. And you must never have more than 75% in stocks, keeping the remaining portion strictly in bonds or cash. For the vast majority of defensive investors, the optimal division is an equal 50-50 split between these two major asset mediums. This 50-50 formula acts as a behavioral shield. It prevents you from getting swept up in extreme market panics and bull market mania. Traditional financial planners tell you to base your asset allocation on your age, but this advice is dangerously mathematically flawed. They tell you to subtract your age from 100 to find your stock percentage. But age does not measure true risk capacity. An 89-year-old with $3 million and a large pension should keep stocks for her grandchildren's future decades of investing. Conversely, a 25-year-old saving for a wedding and a home down payment should never hold an all-stock portfolio. Life is highly unpredictable. Career changes, sudden disability, divorce, or corporate layoffs can strike anyone, at any age, requiring massive liquidity. Keeping at least 25% in high-quality bonds provides a vital cash cushion that protects your backside and peace of mind. When the stock market takes a terrifying, inevitable plunge, this stable bond cushion gives you the psychological courage to hold on to stocks. Without this buffer, history shows that most retail investors panic, selling out at the absolute bottom and holding nothing but bitter regret. But how do we manage this 50-50 split without guessing which way the stock market or interest rates will move next? The answer is mechanical rebalancing. You establish a strict, unemotional calendar schedule, rebalancing exactly every 6 months, no more, no less. Suppose a massive stock market rally pushes your common stock component up from 50% to 55%. You automatically sell 1/11 of your stock portfolio and transfer the proceeds to bonds to restore the exact 50-50 balance. Conversely, if a brutal bear market drags your stock allocation down to 45%, you execute the exact opposite action. You use 1/11 of your bond fund to buy additional equities, forcing you to buy low and sell high entirely mechanically. This brings us to a critical question. How should a defensive investor select the individual common stocks for their portfolio? Most retail investors farm this job out to active mutual funds, believing that professional stock pickers will consistently beat the market. This belief is a multi-trillion-dollar delusion. The financial industry is built entirely on selling the fantasy of market-beating performance. In reality, the average active mutual fund fails to pick stocks well enough to overcome its massive internal operating and transaction costs. Think back to the hottest mutual fund managers of 1999. These media darlings were praised as absolute financial geniuses. The Janus Global Technology Fund gained over 200% in 1999 alone, attracting billions in retail cash. But over the next 3 years, the Janus Fund crashed relentlessly, wiping out the life savings of late-buying retail investors. Even worse, the ProFund's Ultra OTC Fund collapsed 73% in 2000 alone, instantly obliterating its high-flying reputation. The historical data is devastating. Over a 20-year horizon, over 85% of active mutual funds failed to beat the index. Active managers face 4 structural obstacles that make long-term market outperformance mathematically impossible. The first obstacle is migrating managers. The moment a star stock picker compiles a great record, rival firms headhunt them away. The second obstacle is asset elephantiasis. Outstanding performance attracts hundreds of millions in weeks, making the fund too large to maneuver. A giant $10 billion fund cannot buy small, nimbler stocks without triggering regulatory ownership blocks or artificially driving up stock prices. The third obstacle is transaction expenses. Trading giant blocks of stock creates massive market friction, brokerage commissions, and hidden spreads. The average active fund holds stocks for only 11 months, meaning rapid-fire turnover acts as a highly corrosive acid on returns. The fourth obstacle is herding behavior. To protect their lucrative fee income, large fund managers become highly timid and imitative. They buy the exact same prominent stocks, in identical proportions, moving in a sluggish lockstep to avoid ever standing out. When you add average operating expenses of 1.5% and hidden trading costs of 2%, the typical active fund must outperform the market averages by 3.5% every year just to break even. Why engage in this rigged game? Why waste your life trying to pick the single winning needle in a volatile market? As the legendary index fund pioneer famously stated, why look for the needle when you can own the whole haystack? This is the mathematical logic of the index fund. It owns every single stock in the entire market, all of the time. An index fund has no highly paid managers, no marketing budget, and carries a rock-bottom operating expense of just 0.2%. By simply matching the market's return instead of trying to beat it, the index fund quietly, relentlessly outpaces active managers. Over 20 years, a low-cost index fund will beat 5% of professional investors, turning boring indexing into absolute wealth. If index funds are your weapon of choice, then dollar-cost averaging is the ruthless mechanical system you use to deploy them. Financial advisors frame dollar-cost averaging as a boring, conservative savings plan. They are completely, fundamentally missing the entire point. In reality, dollar-cost averaging is a predatory accumulation engine that exploits market crashes to buy valuable assets at deep clearance prices. The mechanics are absolute. You invest a fixed dollar amount, say $500, every single month, without a single exception. Do not look at the news. You do not look at the news, you do not track interest rates, and you do not try to time the bottom. When the stock market crashes, your fixed $500 automatically buys more shares of the total market index fund. When the market rises, your fixed monthly payment automatically buys fewer shares, protecting you from overpaying. This automated transfer completely takes away your power to self-sabotage, removing fear and greed from your wealth-building equation. Let us examine the historical proof. Suppose you had invested a lump sum of $12,000 in stocks in September 1929. Just before the Great Depression, you would have watched your lump sum wealth shrivel to $7,200 10 years later. But if you had started with $100 and added $100 every month through that brutal, deflationary decade, your total accumulated investment would have grown to over $15,000, turning the worst financial crisis in history into a major victory. The exact same mathematical magic worked during the dot-com crash from 2000 through 2002, protecting disciplined monthly savers. While one-time lump sum investors watched their portfolios collapse by 41%, systematic monthly savers lost only 30%. More importantly, those cheap shares bought during the crash built an explosive base for the massive, wealth-multiplying recovery that followed. To build your own autopilot fortress today, you can divide your stock and bond allocation into 3 simple, low-cost index funds. Put 60% in a total domestic stock index, 20% in international stocks, and 20% in high-grade bonds. This incredibly simple 3-fund portfolio ensures that you permanently own nearly every major income-producing asset on the face of the planet. By fully automating this system, you unlock the single most powerful phrase in all of finance. I don't know, and I don't care. Will bonds outperform common stocks next year? You answer, I don't know, and I don't care, because my autopilot system automatically buys both. Will technology stocks crash and healthcare stocks soar? You answer, I don't know, and I don't care, because I permanently own both. Which small startup is the next big tech giant? You answer, I don't know, and I don't care, because my index fund owns it already. Acknowledge your fundamental ignorance of the future and accept that you cannot predict the stock market's erratic, manic-depressive movements. This profound intellectual humility, combined with mechanical, automated discipline, is the defensive investor's ultimate and completely invincible weapon. Turn off the financial television, ignore the daily market noise, put your portfolio on permanent autopilot, and let time compound your wealth.